Hi everyone, I'm Lucas, and I'm a high school student that makes personal finance videos, mostly for teens and minors. Today I'm going to be talking about reasons to buy stocks. Let's first discuss the reasons why you should buy them over other assets. These will be long-term capital appreciation, dividend income, compounding growth, liquidity, ownership, and diversification. Let's discuss one at a time. First is long-term capital appreciation. A lot of these stocks can offer these attractive long-term returns. Stocks offer some of the highest potential growth and value compared to other kinds of investments. For example, let's look at the S&P 500 index. The S&P 500 index has returned approximately 303% during the last 10 years. That means that if you invested $1,000 10 years ago, you would have around $3,677 today. The average annual return is over 15%, which is well over inflation. Even adjusted for inflation, it's around 12%. Now, keep in mind that these returns are high by historical standards. Long-term averages are around 7% growth after adjusting for inflation. That is still very attractive compared to other financial assets. So stocks are definitely an asset class you need to have in your portfolio when you're prepared to save and invest. Next, we're talking about dividend income. Many companies will pay dividends, and these are predictable payouts to shareholders demonstrating profit return produced by a company. They typically happen every 6 months or every 4 months. It gives you a steady income stream. Now, keep in mind that some high-growth stocks, especially in the technology sector, don't pay dividends because they're reinvesting all their profits into growing the company. So keep this in mind as you explore stocks. Let's discuss compounding growth. If you decide to reinvest the dividends into more stocks as they are paid out, you are creating compounding growth. This means that your payoffs are creating more returns in the future, and your money grows faster. Then there's inflation protection. If you look at the long-term returns from the stock markets, they are typically higher than inflation. On the other hand, when you keep money in a regular bank account, the interest you get is well below inflation. Watch my video about high-yield savings accounts, link on the screen, to learn more about saving via bank account. Then there's liquidity. Liquidity is a very important concept that's not only incredibly important to people in the finance industry, but that most advisors and people making videos don't actually understand. So what is it? Simply said, it's a reference to how easy it is to buy and sell an asset during regular times, but especially when the markets are having problems. When the economy enters a serious recession, or even during short-term crashes, markets become illiquid. How easy is it to sell, say, a house during a recession at a decent price? How easy is it to sell a work of art or a collectible toy when the economy is in trouble? The same applies to stocks. Because stock securities have an established market and an exchange that facilitates trades, today it's very easy to buy and sell most stocks, typically with just the click of a button. That makes stocks one of the most liquid assets you can own. There is a value to that, especially at times when you need the money fast or other assets are hard to sell. Next is diversification. It's another very important financial concept. It simply means that you don't want to risk all your money by putting it all in one asset. You want to own stocks to diversify from other investments. But also when buying stocks, you don't want to own only stocks in one company. If that one company gets in trouble, you could potentially lose all your investment. Buying a variety of company stocks helps you spread that risk out. You want to consider both different companies and different industries. Obviously, it can get expensive to own a decent amount of stocks in, say, 10 or 12 companies. So an alternative is to invest in a fund that represents a group of stocks instead of buying individual stocks, especially when you're starting out. Each approach has its advantages, so let's spend some time discussing them. But before them, last and most importantly about stocks is ownership. One cool outcome of buying stocks in companies is that you get to claim that you're a shareholder, a partial owner of the company. Even if you own just 10 shares of Apple or Microsoft, you're still an owner. So simply put, yeah, you can say you own Amazon for the price of one stock. So Let's compare individual stocks and funds. Why invest in stocks? Investing in individual stocks has its advantages. You're a direct owner of shares of a company. You're not relying on others to control that investment for you. Whenever you rely on a third company or a manager to manage your money, you'll be paying them fees which reduce your investment returns. Also, you have more flexibility to invest in specific companies that you like and believe will produce the best results. On the downside, as discussed, you'll need a significant amount of money to have a diversified stock portfolio from at least 10 companies. You'll also be responsible for analyzing those companies and readjusting your own investment strategy. Investing in a fund can take different approaches. There are mutual funds, index funds, and ETFs. One is to invest in mutual funds. Typically, a fund manager will pull money from out of investors and invest in a variety of stocks. They'll manage and adjust that portfolio of stocks. You will, in return, be paying them a management fee. Those fees can sometimes be hard to justify, so make sure you understand the fees before buying mutual funds. These types of funds are known as active funds because you have a manager actively making investment decisions. An alternative is to invest in index funds. Index funds can take the shape of a passive investment. Rather than a manager actively taking a view on what assets to hold, the fund simply tries to replicate the market index. For example, a fund might replicate the S&P 500, which tracks the performance of about 500 of the largest publicly traded companies in the United States. This can be a good strategy if you're happy to just invest in the market overall as opposed to specific stocks. And you can do so without having to afford investing in a lot of companies individually. Often there's still a fee for the fund, but most reputable companies charge a very reasonable fee compared to managed funds. Finally, you have ETFs, which is short for exchange-traded funds. ETFs are a hybrid of mutual or index funds and stocks. You're investing in a basket of assets, similar to a fund, but they're traded like stocks. You can buy and sell them at any time during trading hours. Traditional mutual funds can only be bought or sold one time during the day at the price where the market closed. I hope you found this introductory video about stocks useful. Make sure to hit the like button and subscribe, and in my next video, I'll discuss how to open a brokerage account for minors and teens, so stay tuned.